So welcome to the first subsection of the first section where we talk about structure. So ultimately, all smart money and institutional order flow is grounded in the idea of structure. And why is that so? Okay, well, let's get out our fun and dandy paint tool and let's talk about this very quickly. So when you have structural moves in this market, so let's draw out a very normal, or what a lot of people understand to be a normal bullish structure, which is a high being put into place, a low being put into place, right? And then the higher highs being put into place, higher lows being put into place, higher highs being put into place, higher lows being put into place, and basically the continuous expectation that this is going to continue until it no longer wants to. Now, what is the importance of understanding that markets move in a structural way like this? Now, as we look at this, again, what you have to first of all dissect yourself from is the idea. So again, this is a higher low, this is a higher high. You have to move yourself away from the idea that there are trend lines being printed here. Despite the way I drew it, which makes it appear like we're in some kind of channel and there's some kind of trend lines that are available here, this can move in a variety of ways. A bullish structure does not have to respect any given lines, support, resistance, or trend lines or channels when it's moving in a bullish nature. A overall bullish trend can look like this. Okay, this is variant 1 because this is ultimately what it is. Variant 2 is the exact same thing, where you pretty much don't have a channel, right? You have a high, a low, a higher high, higher low, 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 higher high, and so on and so forth, right? As we draw this in, you can start to very quickly notice how the idea of channels, of ascension, of triangles, of anything of that nature is ultimately taken apart by the way price is moving. Now, as we look at this, you'll also recognize that retail may define and actually explain away the movements in this price with the idea of triangles, with the idea of trend lines. However, what you also have to understand is that every single move in this market is explainable by a retail way. However, they can't trade it because since you can explain any given move using retail, it's very hard to actually give you a way of trading this. You don't know that this triangle pattern has formed until after it has formed and price is broken out. You don't know that this new ascending, or whatever you want to call it, megaphone pattern triangle is forming until it has gone ahead, broken out, and formed. And you have no options of getting involved, nor do you know how to get involved. And even if you did, your RR is usually found to be significantly lower. So ultimately, there are two scenarios for what you can expect in structure. Structure can be found in a delivery that is more channel-like, or can be delivered in a way that is significantly less channel-like. The most important thing when it comes to structure is that we are making moves in the market that are consistently creating higher lows as it's making higher highs, or creating higher highs, right, while consistently creating higher lows in the market. Now, what is the importance of understanding the structure, and why is it not necessarily a retail concept, and how does it play into smart money? Okay, so the idea of structure ultimately, and why structure holds over a longer period of time, especially if you go to a daily or even a weekly chart and you look at structure, or maybe even a 4-hour, the reason structure holds usually for a longer period of time is because within structure, what's actually happening is smart money is getting involved. And what I mean by that is, as you all understand, the composite man, right? So the composite man is the person that has the most money in the market. It's ultimately what we can consider to be the institutions. It's a Wyckoff-based concept. Look it up if you'd like to. But just remember that the composite man is nothing more than the person with the most money in this market that can control the delivery of price and where it wants to go, because that person wants to make money using the liquidity in the market. Now, as he does this, he will deliver price in such a way that, again, will clear out liquidity. So if there was, for instance, a lower time frame, down move here and the creation of liquidity in the form of some equal lows, the composite man will sell through those equal lows, coming higher, leaving behind what is known as a demand zone. Or this is where the idea of supply and demand comes from. This demand zone is an area where he has many orders that he needs to get rid of. And again, we will talk about this in the future, so don't worry about it right now. But when he does this, what's actually happening as he accumulates a ton of buy positions is he's overall bullish on this market, right? And what you have to understand about that is, even though the composite man within the price action of this bullish move will sell and buy multiple times. So this is the idea of buying to sell and selling to buy. It comes from, although he'll sell multiple times in here, he'll buy multiple times in here, he'll sell multiple times here, and he'll sell and buy all the way inside of all these price actions to create highs and lows throughout the market. Overall, the comp man is bullish on this market. And what that means is he will not get below real structural points in this market, because below those points, he will ultimately be negative on positions that he should not be negative on in the first place, because overall, those positions are holding at a overall profit to him, okay? So this is why structure is delivered to you in a specific way. This is why structure is the foundation of the way smart money or institutional order flow plans its trades into the future. That is why a lot of the time, higher time frames hold with structure, because what's happening is if they get below a certain structural point, and why we call that invalidation is because usually it will be for the purpose of reversing completely. So, you know, this will be the delivery of price in a bullish structure, and the same things inside will occur. However, we will talk about that in the next video. The most important thing that you recognize about structure right now is it's nothing more than delivery of price with highs and lows, higher highs and higher lows, higher highs and higher lows, or right, the opposite of that. So if we just flip this, you would then see the complete opposite. What I mean by that is you could see the low, the high, the lower low, lower high, lower low, lower high, lower low, lower high. That is also the same thing. And by that same nature, if this was number one, right, the number two would look like this. So you'd have a low, a high, a lower low, a lower high, lower low, lower high, a lower low, a lower high, lower low. Forget that we have this one in the way. But ultimately, price does not have to be delivered in any given, like we said, any given channel or any given trend line. Instead, all it has to be doing is putting in major points, major swing points that are higher than the previous one if they're in a bullish structure, or lower than the previous one if they're in a bear structure. And the first time we can look at that is right here. So we'll go ahead and open this up. Maybe let's go to a 4-hour and just talk about where structure ultimately is here. So let's go back here, and this is going to be a very simple way of looking at it, but using your own eyes, you should be able to tell where structure is heading. What I mean by that is, let's say we use this point. This is a high being put into the market. Then we put this low into the market, okay? After putting this high and this low into the market, the next high we put into this market is ultimately right here. Now, from this point, when we put this high into the market, we can already expect that we are most likely bullish, as we are starting to clear liquidity to the top side, moving higher from areas of demand in these areas, right? So again, when we're buying from areas, when we're basically bullish, we're looking for trades off of areas of demand. And when we're selling, we're looking for sells at areas of supply, and so on and so forth. And we're going to be talking about that down the line in the course, but just keep that in mind for now. So like we said, if they are overall bullish, they will hold that bullish structure until they are ready to shift to a different structure. Okay, and in this case, we're just looking at this time frame, and we'll talk about different time frames very soon as well. But what we'll see is we're delivering price in a bullish manner now. So we can expect the next zone to guaranteed be above this low here, because they've already mounted multiple buy positions here. And for any of you that have been here a while or have seen the YouTube videos, there is Wyckoff occurring here. So again, what's happening? They've accumulated tons of positions in here, creating areas of demand that took out liquidity here, and now moving higher. And as they do this, they do not want to get back down below these points, because then they will be at a negative and they won't be able to take a lot of the buys that they got into at these areas of demand to the higher points in price. So as a result, we follow that structure down to the new low that is created within here. Now we can expect for potentially, you know, lower prices to be met as long as they don't get below this, or higher prices to be met. And that's exactly what we get. We have higher prices being met above new highs. And what do we expect? That price does not want to get down below this structural point again. And lo and behold, that's what we got. Now we put a new high into place. Now the same expectation occurs. We are never expecting, unless we start to intertwine what we see here with the higher time frame, for the price to reverse, right? Unless we had a supply zone that we were looking at from the past at or around these levels and expecting price to be bearish from here, we are not going to be changing our expectation of what a given time frame is doing. So this is now where we get a little bit in the time frames. And the reality is, as this high is put into place and we're still clearing liquidity to the top side, we will expect that the next low that's going to be made is not going to be below here, but instead it's going to be just above it, looking to meet even higher prices. Now, in this case, the price has now shifted bearish, right? So let's make this red very quickly, just like that. There we go, very nice. Oops. There we go, very nice, very nice. So the second we put in this low, price has shifted bearish, okay? And what we mean by that is now order flow has shifted to go bearish, which now means, according to the little document we put here and what you should now have in your notes, we are ready to begin potentially putting in this schematic right here, right? Which are the lower highs, and the lower lows, and the lower lows, because we are delivering price to the bottom side now where we're going to go and clear liquidity. So what do we see? We follow this up, and we know that the next point that is going to be made in this market should be under this point here. And lo and behold, that's exactly what we get. Now, what do? We follow that back down. It comes and makes a new swing low. That swing low is created, and now we know what? That the next swing point has to be the low here, because that is the liquidity that is currently holding. So we follow that up, and we have it happen here. Now we follow it down. Again, we put a new swing point in right here. So now that this has happened, we have an expectation. And if any of you saw, you remember we were selling this area. Doesn't really matter right now. Why are we selling this area? Because we had believed that prices could create a new bearish structural point that would then lead us to new lows. Now, instead of that happening, price failed to go lower and began to print what we've seen in the past, right? Which is bullish structure. And what I mean by that is when this low forms, we don't know if bullish structure is in or ready to go yet, right? Until we break this, ultimately, the bullish structure has not been put into place yet. However, the second we break this again, we see a new structural point being put into the market, which is showing us what? That smart money or institutional order flow on the 4 hour, right? Because again, depending on the time frame you're on, structure will change. On the 4 hour, price has shifted bullish. And the expectation now from the delivery of price is that price will not get back down below this low. And we will continue to have this bias play, right? Expecting this, expecting this, expecting this, expecting this, until we are shown otherwise. Now, you have to recognize very quickly that we don't just use structure to trade and get involved in the market. That is because we are not ever sure if a structure wants to hold in a given direction or structure wants to change in a given direction, right? As we see here, does it want to hold in that given direction or does it want to change in another given direction? And that is what's happening here. So structure can be delivered to you multiple ways. Understanding structure is literally about looking at it and seeing where the swing points in the market are being created. You have two main ways of looking at it. You have to diverge yourself from the idea of thinking that it needs to move in a channel. Otherwise, you will miss trades and you will miss what the structure is actually telling you. Because just like this is a bullish structure right here, this right here is also a bullish structure because of the way it's moving. Now, in the next video, we're going to take a little look at fractal natures and we're going to talk about structure in that sense. But hopefully this specific video allowed you to understand how structure in the market can be delivered and how structure in this market can switch back and forth. Just because we're bullish does not mean price can go bearish. Just because we're bearish does not mean price can't go bullish. Just because we're bullish for a long time and then become bearish doesn't mean it has to be bearish for a long time. In this specific case, I guess it was, right? We were bullish for a little while, for a few swing points. Then we became bearish for a few swing points. Then we became bullish, and maybe it's going to be for a few swing points. But there's nothing telling us that it's going to hold here. The probability of it holding is becoming higher due to the way that structure is being delivered and due to the idea that we believe that after this liquidity was taken and we had created these areas of demand in here, which again we will talk about down the line in the course, we are expecting probability-wise for structure to continue holding and delivering higher prices above new liquidity points, which again we will also talk about in the future. So if any of this stuff is a little bit confusing to you, do not worry. This is the first subsection of the first section of the entire course, and this is just dealing with the beginnings of how we should see structure and anticipate structure and why structure is important. And structure is important because when you understand where structure is heading, you understand that institutional order flow will head with it. Because institutionally, if the prices want to go higher, they will not get down below their institutional swing points, since those points will put them into negative positions. So thank you for watching, guys, and I will see you in the next one.